Hi everyone, in this video we will be covering another important topic, that is impairment. So up till now we have covered definition of financial instrument, how when to recognize the financial instrument, how to do the accounting and classification of financial instrument. Now the second last topic is the impairment. What is impairment? So if you Google it, you will find whenever there is reduce in the value of asset is called impairment. So this bottle used to be value around $50. Now it's only 50 cents. It means its value is impaired. That the market value is less than the company's balance sheet value. So what to do in that case? If you have a bond whose value you were showing it around let's say $100, but if you go and sell in the market you will be getting around $50. So what do we need to do for that $50? You need to show it to P&L, but how and when and what's the amount? Let's see what IFRS 9 has to say. So it says the impairment model in IFRS 9 is based on the premise of providing for expected loss. IFRS says whenever you see that in this asset, whatever assets you are trading or investing, you see that there are chances that it may default. There are chances that you will not get the full principal or the interest expected. It says follow the prudence and show it as a loss. You don't need to wait for the loss or accounting event or any financial event to be incurred. You know that there are chances, there are probability. So basis on that probability, basis on your calculation, basis on the actuarial calculation, show that expected loss as part of your financial statements. You need to show that. What IAS 39, that the old standard for financial instrument, it was not on the basis of expected losses. It shows the impairment basis on the incurred losses. And that is one of the reasons for the global financial crisis that happened in 2008. Okay, so that has been criticized, and now we brought a new section, a new chapter, a new theory that you need to show the impairment loss as per expected loss. At any point of time, you invest any good asset, it says you have to show at least 12-month expected credit loss. You invested in a bond, you say that there is 1% chance that you will not get 100% money. You will get only 10% money back. So what you will lose? You will lose 10%. That is, if you have invested 100, you will be getting 90, and you will be in a loss of 10. And what is the chance of that loss? And the chance is like 10%. So 10 into 1, 10%. So you need to show an impairment loss of $1 in your P&L account. It can be million or it can be billion. And just for the sake of simplicity, I have taken this amount for the purpose of calculation. I hope it's clear. So expected credit loss are required to be measured through a loss allowance account. So how we show the expected credit loss and how we calculate it, let's see. So it says you have to show 12-month expected credit loss. At this date, when you initially recognize, you will assess that what are the chances of expected credit loss in the upcoming 12 months. And that you will show as a part of impairment loss as a loss allowance account. Or you need to show full time expected credit loss. When you need to show the full time expected credit loss, that if there is Credit risk has been significantly increased after the initial recognition. If the credit risk have been significantly increased, you need to show the full lifetime expected credit loss. You calculate that what is the final amount you will get, and you need to recognize full lifetime expected credit loss in your financial statement. But anyhow, if nothing is happening, you always need to assess 12-month expected credit loss in your financial statement through a loss allowance account. You will always be charging impairment loss on your financial assets. If you would be doing the traditional accounting, you would have been wondering that what is this, how it has been coming. Earlier, it never used to be part of your books of account in the earlier days of IS 39 and all. It used to be come into a picture when there his loss has been incurred. But this is prudence, we can say that we always need to show the things we can estimate as of day to day. There is one exception to that where you always need to show full lifetime expected credit loss, and that is totally reasonable whenever you purchase a already impaired asset. Whenever you purchase impaired financial asset, then in that case you need not to show the 12-month expected credit loss. You need to show full lifetime expected credit loss because that event has already been occurred. You bought already an impaired asset. And in that case, you always show full lifetime expected credit loss, and any change in that impairment loss you will take into P&L. Okay, let's summarize. So we can divide our assets into three categories, that is amortized cost, second is fair value through OCI, and third is fair value through P&L. So in the case of fair value through P&L, you'll always be showing your asset at fair value and changes recorded in P&L. There is no question of impairment. There is no need to take any additional charge to P&L. So it does not apply to this because you're already showing it fair value and you are taking all the changes in the fair value to profit and loss account. In case of amortized cost, if there is a change and there the credit, the asset is impaired, then you need to check the impairment loss to P&L, the method I already told you, and we'll see more in example. And if you're taking fair value through OCA, the changes you recorded in OCA, but if the value is increased, the impairment loss is taken to P&L. I hope it's clear. So what amount you will take? You will take 12 months expected credit loss at the initial recognition. But if there is significantly change in the if there has been any event, accounting or financial event which results into the credit risk have been significantly increased, then you need to take full lifetime expected credit loss. I hope it's clear. Let's see through an example. So what it says. So we will just take the question that we have taken when we did the accounting for bonds. So it says that you are ABC Incorporation and you bought a bond of LMN INC with a maturity on 31st December 25. You paid 9,200 and incurred transaction cost of 250. The bond value is 10,000. That is the face value, and on which you will be getting 5% coupon, that is 500, and it is paid on every year at the end of each year. And the bond trades at this date, and it estimate that there's a probability of default of 0.3%. And how much you will lose? You will lose around you will lose 30%. So you need to recognize that impairment loss. You need to charge this much amount to your PN. Let's see. And it says that it meets the cash flow test. That is, the business model is just to collect the cash flow, and the cash flows are made up of solely payment of principal and interest. So it need to be measured at amortized cost. Let's see the accounting entries. So the fair value is 9,200 that you paid, and in this you add the transaction cost. So the cost to the organization for that bond is 9450. You will show it at this point, and at the initial recognition, this is your fair value 9450, and the cash is gone, or you can debit credit the nostro. So bond account debit to cash, that is when you bought an asset, and subsequently you calculate what is the actual return you are earning. So you have paid 9450, and this you will earn, and at the end of you will get principal plus the interest. So the actual return on this investment is 6.32%, and you will calculate your amortized cost. So on this carrying value, you will be earning 6.32%. You will take this interest income to your P&L, okay, and out of this you will get 500. So the carrying value will be 9450 plus 597 minus 500, 9547 you will show in your balance sheet as the value of your bond. Okay, now comes the twist. Now comes the next thing that you have not learned yet, that is impairment loss. So the probability of default is 0.30, and you have 9547 value. Out of this, you will lose 30%, and the probability of loss is 0.3%, and it comes out to be 8.59. So you will debit 8.59 to your P&L, and you will make a loss allowance account, that is, as you will credit the asset side with a loss allowance account of 8.59. I hope it's clear. That is how you recognize the impairment loss when there is no significant increase in the credit risk. Now let's see what it has to offer. So if this is the case, you will continue to show your income at this debit asset 597 and credit income this much amount, and debit cash that you will be getting and credit the asset with the coupon amount. So these are the amount entry you will pass. Now it says in 2023 an event occurred. It says the issuer went into liquidation. Oh my God. And you will be getting only 75%. So liquidator decided that you will not be getting any interest. You will not be getting any interest, and just you will be getting 75% of the bond value. So you need to get 10,000 at the end of 2025, out of which you will be getting 75%. That is nothing but 7,500 after 2 years. You are in 2023. So in 2023, you assess that you will not be getting the full amount. You will just getting 7,500, that too after 2 years, and no interest will be paid. And market interest rate on similar bond is 6%. So you will calculate what you will be getting. So you will be getting 7,500 after 2 years. You will discount this and calculate, show the actual present value, actual fair value in the books of account. That is 676675. That is the present value of 7,500 that you will be getting after 2 years. I hope it's clear. So what was the book in your book value? What was the value of the bond? The value of the bond in 2023 was 9760, and out of that you will be getting 6675. So 3084 is your loss due to impairment. I hope it's clear. Out of this 3084 impairment loss, you already charged 8.59 to your books of accounts. So you will charge additional impairment loss of 3076. I hope it's clear. And now you will start showing your interest income on 6675, and the rate of interest is 6%, and you've discounted with the same rate. So you will be charging, you will be getting in, you will be showing interest income of 400. There is no cash receiving, so zero. You will add this 6675 plus 400. So you would be showing this amount in your balance sheet, that asset account. And on this, you would be charging 6% in the last year. So you'll be showing an income of 425. And then you'll be getting, if you add 6675 plus 425, it comes out to be 7,500. I hope it's clear.